When you look at fear financially, I think they're scared to destroy their future. They're thinking, man, if I don't protect this money that I've brought in, then it could just go away forever. But it's crazy statistically. I put a stat out the other day on social media. It's something like 50% Americans don't have $500,000 saved for retirement, and like a higher number only have $100,000 saved. And so we're sitting here, the same people who say, I'm too scared to invest in real estate because it's risky, it may hurt my financial future. Bro, they don't even have a financial future to start with. It blows my mind. All right, I'm here with Andrew Freed from Worcestershire, Massachusetts. Is that how you pronounce that? Did I like totally butcher that with some southern accent right there?
You very much did butcher that. Yeah, it's Worcester, Massachusetts. But to your defense, every city in Massachusetts doesn't read how it sounds.
Did I
So,
literally say Worcestershire? I said Worcestershire like the sauce.
and I get it. It's spelled the same.
Oh
Like
my
I get
gosh.
it, but and it's pretty common. So it's not just you, all right?
Oh my gosh, what a great way to start the show. That's hilarious. Well, Andrew, I'm super excited to have you on. Started in real estate 3 years ago. You've done 25 plus deals. You've done a lot of different type of real estate, really focusing on the multifamily nowadays. And you're going to be super helpful for all the folks out there listening. But give us a little backstory, who you are, and then that journey that got you into real estate just 3 years ago, because you hadn't been doing it very long and you've had a lot of success.
Yeah. I mean, I definitely lucked out in regards to timing and getting involved right during COVID during a 20 to 40% boom in appreciation, right? But what really started my journey was I did the normal American dream, went to a good school, got a good education, got a good job, got to six figures, got a nice swanky condo in a city, right? Like I did the American dream. And then come COVID, I came to the realization like that I am still paycheck to paycheck. Like, yeah, maybe I have 6 months, 12 months of reserves, but I still got to go crawling back to that job. And that scared me more than life itself. And I really came to the realization that it's like, do I want to work for 30, 40 more years of doing what I've been doing for 7, 8 years? Or do I just want to take a dive, put my net worth at risk? And, if I fail, whatever, I'll retire at 30 to 40 years, just like everybody else.
Yeah.
And that's exactly what I did. So during COVID, I took out a HELOC, a home line of credit on my one bedroom condo in Boston that I bought back in 2015. And I used that money as seed money to start buying multifamily in Worcester, Massachusetts. I did a couple house hacks, bought a couple properties, joint ventured. And then when I kind of ran out of my own money, I started raising money from other people and getting in the syndication space. So as of now, 3 years later, I went from like one unit to, I believe I have 127 that I
Jeez.
own, and then I have 5 under contract right now.
Wow. Yeah, one of them not too far from me here down in South Carolina, my neck of the woods. Dude, that is amazing. You said something there that I was having this conversation with a friend yesterday about people being fearful, whether it be real estate. Me and you're in real estate. So we hear people having a lot of fear of investing in real estate, but it could be the stock market, it'd be starting your own business, whatever. When you look at fear financially, I think they're scared to destroy their future. They're thinking, man, if I don't protect this money that I've brought in, then it could just go away forever. But it's crazy statistically. I put a stat out the other day on social media. It's something like 50% Americans don't have $500,000 saved for retirement, and like a higher number only have $100,000 saved. And so we're sitting here, the same people who say, I'm too scared to invest in real estate because it's risky, it may hurt my financial future. Bro, they don't even have a financial future to start with. It blows my mind.
You're exactly correct. And it's like people are fearful of losing what? The status quo where you're not going to
Mm.
retire with barely anything? Or do you want to I feared the status quo. And that's why I had so much motivation to really go for it. And so it's like I think people need to switch it around. It's like, is this current lifestyle what you dreamed your life to be? If not, fear that and go for your dreams.
Yeah, it's almost like a little bit of YOLO, and you can't be flippant. Like you don't go through life being a flippant person saying, "Oh, YOLO for real." Like whatever happens, happens. Like you have to be
Hmm.
calculated, strategic,
Totally.
educated. But at some point, there is a little bit of that says, "Bro, we got one life to live."
Hmm.
Did I, when I was 15 years old, 12 years old, was I excited about showing up to the same place every day, doing the same monotonous task over and over and over? Is that what my dream was? Or was I like the meme that you always see? It's like most men, you know, whatever die at age 25 but aren't buried till they're 65.
Hmm.
And unfortunately, all too often it happens all because of fear. And it's like, what's the worst that's going to go wrong? You're going to screw up, lose your investments, which you don't want to do, but then you start over. Okay. Like that's what you were going to do anyway. It's like you weren't going to have any wealth or any money anyways. I don't know. It blows my mind.
And I mean, and is complacency and is status quo fun? I mean, imagine your childhood. It was so vibrant. You had so much
Oh,
experience
yeah.
from 0 to 20, right? Then 20 to 30, it's just a blink of an eye because you're
Yep.
doing the same thing over and over and over and over.
Mm.
So, like, just the fact that, like, you get to switch it up every day, like, you live a life that you truly want to live, like, makes this life more vibrant, in my opinion.
Dude, that is one of the best explanations of it I've heard. It's like we are so there's so much going on for those first 20 years. Everything's new and exciting. And then it's like, bro, you hit it. You get to 20s to 30s or 22, say you're in college to 22 to 23. And it's like you're excited, you get started in work, and then boom, it's done. And you're like,
Mhm.
bro, what did I even do with my 20s? What am I doing with my life? And from an entrepreneurial standpoint in the real estate space and then now with the finance cowboy brand and other things we've got going on, it's not like always roses. Me and Andrew don't want to sit here and lie and act like, hey, this is the easiest. No, the other's easier. The other is easier as far as a day to day, but as far as the as getting that exhilaration, um, discovering new things every day, feeling fulfilled, dude. I work more hours doing what I do now than
Yeah.
what I did when I had a stable. Just like, hey, every day we know we're doing this, but it's like you don't feel it. Like I don't know how to describe it. Maybe you can do a better, but it's just exhilarating every day. You're
It's
excited about it. You love it.
You have a path, you have a goal, you have a direction. Like when you're in your day to day, it's literally like what is it, Groundhog Day? It's like, what are you really aiming for? You're aiming
Mm,
for this long goal 40 years down the road that I literally can't even imagine. It's like you're just like it's almost like you're wandering the desert aimlessly, in my opinion. And like when you have a business, when you have goals, when you have dreams, it's like life is just it's just your path is just so much more clear.
yeah. Now, one thing I will say, and we'll get into real estate. I don't know how we got on this tangent, but I'm loving it. One thing I'll say is you can leverage the status quo. From my experience, what you are doing now, if you are, in the stable job, something you don't love, but
Hmm.
it's bringing in good income. Let's
Totally.
not just go and quit that today, in my opinion. Leverage that to jumpstart you into your journey. I know that's what I did is I literally for the past 6 years that I've been buying real estate, use W-2 money that I had coming in to get started. And it propels, I say income is the fuel that propels your growth to wealth. Like it's going to
Hmm.
dictate how quickly you can get wealthy. Now, that's at the start until you learn about private money and other people's money. Then you realize you're like, okay, I don't need mine anymore. I'm going to use theirs. But it at least allows you to prove concept to then maybe you can go and raise more money because you said, hey, look what I've done by myself. And so I would encourage everybody out here, and I would love to hear your story too, if this is kind of what you did from the start, even if you didn't, but use what you're doing today as that jumping pad, that leaping board to where you want to get in the future.
I mean, you're exactly correct. You cannot own real estate without having money. I mean, otherwise you're going to go bankrupt. It's incredibly important, and having your W two and leveraging that to make you loanable in the beginning
Mm.
is very important for buying profitable deals. I mean, the most expensive line item in a project is debt, right? And if you could leverage your W two to get the best debt possible, you can make deals make sense where other people's can't, where they're borrowing at 8, 9, 10%. Meanwhile, you get 6.5 from a local credit union because you have a W two job, right? Like it absolutely makes a big difference. And to your point, it's like in the wealth building phase, it's all about making as much money as possible or reducing your expenses as much as possible. If I could work a W 2 while working a side hustle, while self managing my property, like I'll do that all day so I can get to that financial freedom number that much quicker.
Yep. Yeah, use it all. Like grind for a few years. It sucks, but anything worth having is going to take sacrifice in the beginning. Anything. Unless
Totally.
you just get lucky, hit the lottery, or you get handed, an inheritance, which I don't play the lottery, and my dad's a pastor. So I'm getting neither one of those. So for me, it was like, all right, we got a little bit of pay now so that we can play later, a little bit of delayed gratification, which is weird that you said that because I interview, I don't know, tons of people every year. And one of the themes of every successful person, which everybody who comes on my show is a successful person, mainly through real estate, all says delayed gratification. At some point in
Mhm.
our conversation, they talk about, hey, delay it, use your W 2, do this, do that, do things that you don't want to do today. And if you'll do that for 2, 3, 4, 5, 10, 15, 20, I mean, we could be as short term or as long term as we want.
Mhm.
Then if you control that input during that time, you're going to have the life of your dreams on the back end. You don't know the exact date, but just don't stop, because those who win don't quit, and those who quit lose every single time.
Yeah, I mean, you're absolutely right. I mean, I could go many different directions on that, but I totally agree with you. Very important for sure.
So you started with house hacking. That's the golden way to start in real estate, right? How'd you
Hmm.
figure that out? Did you even know that it was called house hacking at the time? I guess if you did it
I did.
3 years ago, maybe you did, but back in the day, it didn't even have that word, and all my buddies used to do it, and they're like, "Yeah, now it's got some fancy word to it." But
Yeah, I mean, I more or less just followed the Bigger Pockets recipe, found Bigger
yep,
Pockets, read all their books, listened to all their podcasts, learned a ton from David Green and Brandon Turner. And I think Brandon Turner recommended, he's like, financial freedom isn't that difficult. Like, if you house hack 10 multis in 10 years, like, that's like 30 units and enough to live on. And to me, like, that seemed realistic to do rather than getting hundreds of units, like just buying one property every
yep.
year at 3, 5% down. That seems super feasible. So that's what I decided to do towards financial freedom, was get my HELOC and house hack, one multi every year for 10 years. So I started, I got an FHA loan. I would think I got like a 2.375, which I'm never refinancing, by the way. I'm keep that FHA loan. And I found a threeplex in Worcester, Massachusetts, house hacked that. Ended up finding my neighbor across the road wanted to sell. I still have money on the HELOC. So I ended up buying the property right across the road, like 150 and 151 Ingleside Ave, which is really good for like managing. It's way easier to manage when they're all
Yeah.
right there. And then they kind of just leveraged that HELOC, bought more multis, and then I ended up HELOCing my first house hack, which I highly recommend, because your HELOC can go up to 100% leverage, but you can only refinance at 80. So why leave that equity trapped in before you leave? And HELOC a house hack before you leave, so you have access to that equity up to 100%, so you can use that towards expanding your portfolio later, or not, just keep it just for reserves, but it doesn't cost you any money to have a line of credit open.
Yep.
And then I kind of just figured out how to utilize lines of credit, and then arbitrage my I became an investor focused agent, self-managed properties, and it just arbitrage all of that money into kind of going into bigger deals.
Man, what a fantastic story. So HELOC, I want to touch on that. What'd that look like? Like, how, when you would pull a HELOC out, so home equity line of credit, you'd
Mm-hmm.
buy a house hack or whatever, a
Yep.
property, then you would
Yep.
pull the equity out either immediately or down the road. Then when you go to deploy that equity, how are you using that? Because people have different strategies on how they use a HELOC. What'd that look like for
You,
you?
everybody says, oh, use a HELOC, pay it off as quickly as possible. Like, I actually took a different approach, because many people don't know that. I mean, HELOCs are interest only, right? So what does that mean? That means that when you go for loans and lenders figure out your debt to income ratio, they only take into account the minimum payment, right? So that means they only take into account the interest only. So more or less, I had the ability to leverage a large sum of money for not a lot of debt against my income,
Mm,
which made me very lendable. So, for example, I think I have like $275,000 in HELOCs out there. I think my monthly payments like $1,400. Like, I own like 100 units. Like, that's nothing. Like, my cash flow far exceeds that.
oh yeah.
Additionally, I use HELOC money for down payments. And people are like, why would you borrow, 20% down at 8, 9, 10%? It's because you got to think not with just the HELOC debt, you got to think holistically with the investment. There's also an 80% note associated with that bank. There's also cash flow associated with that, right? So if the blended interest rate with the HELOC and the bank financing is less than your cash flow, you're using the concept of arbitrage to build wealth, right?
Mm.
So that's exactly what I did. I really mastered the concept of a blended rate and arbitraging that into higher returning asset. And in a matter of 3 years, I think I like 5x my net worth. So it was very effective for sure.
Wow. Yeah, when you can utilize equity, whether line of credit or cash out refi, if you're doing the Burr method, return on equity. I feel like return on equity is not a talked enough about metric in the real estate space, at least on the social media world. Like when I go and I hang out with
Mm-hmm.
real deal investors, we're talking about it. But you don't
Yeah.
see it a lot when you're scrolling down the feed. But if you're not measuring what that return on your equity is, Number one, you should be, and number two, if you're not using that equity, if you're not getting a return on it, then you literally have wealth just sitting there, an opportunity cost that is being missed. And it sounds like you're absolutely crushing it. And you're saying, heck no, I'm going to take every bit of equity I have, maybe not every bit, but I'm going to take the equity that I can access and I'm going to put it to work to continue scaling. And you've done a fantastic job.
And just to take that one step further, I think of it like return on net worth. What is your
Mm-hmm.
cash flow on your entire net worth holistically? And that's where I try to aim at, because that really looks from a portfolio level of like, where's my debt equity? And I'll just give you an example of why this concept is important is because most people have their money locked up in 401ks, or their primary residence provides zero return on net worth. And I realized that quickly. And when I started buying real estate, I took money from those funds that were giving me a 0% net worth, and I put that in the assets that were providing me cash flowing dividends, essentially increasing my ability to reach that financial freedom number as quickly as possible.
This is cool. I love this. I love this. I will say personally, and you may not agree, which is a okay. I've had a lot of people on this show not agree. I am scared when it comes to HELOC of keeping it out, like using it as down payments with the blended rate. Like I want to use the HELOC fast
Hmm.
when it's my personal home. Now, I know I'm speaking from a place of I have a wife and four kids, 7, 5, 3, and pretty much newborn. So to me, I'm like, all right, if I'm going to HELOC this personal home, which I have, not the current one I'm in, but the one I was in previously, I want to utilize it as almost a bridge loan, right? Use it
Hmm.
as private money, hard money, and pay
Totally.
myself back. And a lot of times I'll tell people be cautious with that. But if I'm looking in your shoes or somebody else's shoes, I don't know your shoes, so you may have been married and have a big family when you were doing this. But if I'm looking at a bachelor's shoes or a bachelorette shoes, and they're like, bro, we're getting started in real estate. They buy their first house hack, which is their personal home, and then they're ready to scale. There's a pretty darn good chance I'd pull that HELOC out and do exactly what you did and arbitrage that way to growth as fast as possible. Hey guys, when you're just starting out as a real estate investor, finding deals is the most important thing you can do. But unfortunately, it can also be your biggest hurdle. And let me tell you, it gets even harder when your business grows and you don't have a lot of time to look for properties and evaluate deals like you did on the front end. That's why you need to work with New Western. New Western has properties ready for rehab on their marketplace today. That means you skip the hours of research, driving neighborhoods, or calling agents. And instead, you get to start with a ready-made property. You can rehab and flip it, or rehab it and burr it and hold it as a rental. So why is New Western good at what they do? Well, they buy and sell a property every 13 minutes. They work exclusively with investors and value add properties, and that's all they do. They're licensed agents, they have a network of lenders, and they'll help you grow your business. So if you're ready to jumpstart your next project, visit newwestern.com, join their marketplace, and access the largest private source of rehab properties in the nation.
I mean, and you have a good point. And I don't have kids, and I am single, and it is very much easier to do that for sure. The thing about HELOCs is primarily if you're going up to 100%, they're based off your primary residence, right? So if you move from one primary residence to another, there's a chance that the bank might actually pull that line of credit, right? So if I have $275,000 out there in lines of credit and I take all my cash, I pay it off, and they pull it, which they do a lot during recessionary periods,
Yep.
like I'm out of cash, right? So I would rather be strong in a cash position and have my lines of credit pulled than pay them off and have no cash, then lose access to that line of credit. Primarily because like there's one main reason why businesses go out of business, and it's because they run out of cash.
They
And
run out of money.
they run out of money, and I never want to be in that scenario. So yes, like maybe I have those lines of credit drawn, but my plan is that at the very least down the road refinance them out into one lien, right?
Yeah. Yep. Yeah, you're using them as a tool to scale, and it's a fantastic way to do it. You make a good point. It's like, bro, it costs you nothing. Maybe it costs a little bit to open the line of credit with closing cost or whatever, but once you have it out, it's not costing you much money at all to have it. So go ahead and open the line of credit. Have the money sitting there. If you got a line that you can get for $80,000, bro, you're not paying on that. I think that's what a lot of people get confused with. They think it's another loan. So it's like, hey, I opened this $80,000 line of credit up, and then now I got to pay on this and I'm not using it right now. No, you don't. It's why it's called a line of credit. It's like a credit card.
Yeah.
If you have 80 grand and let's say you only use 40 grand to buy a property, well, you're only going to be paying on that 40 grand that's been sent out and that you're using. The other 40 grand that's still in the account, you don't have to pay on that. And then as soon as you return the 40 grand that you used to buy the property, you don't pay on it anymore. And so it's good to just have it sitting there because when a deal does come up
Hmm.
or you need capital, you
Totally.
need to cover an expense, whatever the case may be, you have access to equity because Andrew put it perfectly. Number one reason people go out of business is they don't have any more capital. And
And
yeah.
and the number one the number one reason why people don't get deals is because they don't pounce quick enough. And people
Hmm.
who have capital are ready to pounce, right?
Yeah.
So to your point, I always try to open up lines anywhere I can. Like I have a business line of credit out on my LLC, right? I have working on a second lien on one of my commercial properties to access equity that way, right? I'm always looking for little pockets of money, and like maybe I don't have a use for it, but I know a deal will come across my desk and I will have a use for it.
Was it hard for you to get used to debt? I know when I first started, I was so big, like we were in 110,000 ish dollars of consumer debt. Now we can talk about good debt, bad debt. So obviously
Hmm.
I'm in a lot of debt myself. I freaking love it now. But I was in
Yeah.
consumer debt when I
Uh,
graduated college and I spent 5 years following old Uncle Dave's plan, which, hey, doesn't give great advice on every topic, but the guy can get you out of debt. And so he got us out of debt within 5 years. And I remember for me, it was a big struggle for me to feel comfortable going back into debt with good debt on real estate. And it was a roadblock that held me back early because I could have scaled a lot faster. I had access to lines of credit. I had access to more private money. I could have taken on more debt, high income earner, but I kind of went at a slower pace
hmm
because of that fear. Is that something that you ever had to work through? And if not, how'd you rationalize it in your mind?
Let me just ask you a quick question. Would you rather have a zero net worth, or would you rather have $5 million of assets that provide that you have no equity in?
I guess $5 million worth of assets all day,
Yes,
every day.
that's
I
exactly
mean, that's
correct.
not
And
even a.
yep, exactly, and that's why I love debt. Is you can utilize debt to increase your net worth, and essentially, and its leverage is incredible. Like say for example you have 5% in a deal and it goes up and the property goes up 10%. Like what is that? What are you, like 2 3xing your money?
Yeah.
Like as opposed to if you brought all cash to that deal and it went up 10 to 20%, you only get 10 to 20% on your money, right? So I think once I understood the power of leverage, combining that with the power of arbitrage, I think that like it was just so much easier to build a net worth. I mean, it took me literally 10 years to build up 250,000 dollars in net worth. 200K of which came into a condo I bought back in 2015. 50K of which it took me 10 years to build up, right? And then once I discovered leverage and arbitrage, my net worth went up 5x. So it's incredibly powerful and it needs to be utilized in wealth building if you're trying to do it quickly. You just can't do it without
But Andrew, net worth is just paper money, right? Don't you know that?
it.
Bro, when people tell me that, I'm like, all right, obviously have no idea. Maybe I used to think that when I was naive and stupid back in the day, but now that I have a large net worth because of real estate, no, no, no. It's paper money until you access it. And guess what? You can access it in many different ways. You can access it to scale with HELOCs, cash out refis, 1031 exchange. I mean, there's countless ways that you can do it, and many ways that you can do it without having to pay any taxes. And
Yes.
I would tell you guys that the power of real estate. I say this all the time, and you may not agree. So if not, chime in, and we can go head to head on this thought process. I love cash flow. I really love cash flow, but your life changing wealth is not going to come. I'm talking about big generational wealth is not going to come from cash flow. It is going to come from how much these assets are worth that you own and how much you owe on them. And as that number continues to spread over time, that is what is going to make you ridiculously wealthy. And there's no better way to do that than through real estate, leveraging other people's money. It is literally a cheat code.
I'll take that one step further, and I totally agree with you. However, I think the wealth is in the principal pay down, like you mentioned,
Mhm.
as well as the tax benefits and the
Yep.
appreciation. The principal pay down, the appreciation is kind of your point. The tax benefits. I mean, like most people pay a 30 to 50% tax rate. Every single dollar you receive, you give 30 to 50% back, right? But if you can utilize real estate to shelter those taxes, your tax rate can go down to 5 to 10%. You
Yep.
literally can get a 10 to 15 to 20% return on your money by sheltering the taxes. take that and compare that to 7% average return in the S&P 500. I would literally pay no taxes and get a 0% return, then get 7% in the S&P 500 and pay taxes on my money. And I
Yep.
think that's the very under spoken about topic is like, and think about that over a 30, 40, 50 year time horizon where I'm getting 30% more money than you. Like that compounds like crazy, right? So I think like that's my favorite part of real estate is the tax sheltering.
Yeah, 100%. I make posts all the time jabbing fun at people who say, you need to buy index funds instead of real estate. I'm like, no. It's just, it doesn't, I'm not good at math. I'm very bad at math. I like failed math in seventh grade and then did terrible throughout high school. Had to pretty much like cheat my way through. Sorry, teachers. I think statute of limitations protects me, but like terrible at it. But I at least know enough to be able to put the formula together to when you look at leverage, appreciation, cash flow, debt buy down, forced appreciation, and tax benefits, when you put all six of those together, then you have just created the greatest financial concoction known to man. And I will to hit on your tax point, he's spot on. I would tell people though who are at the starting level, Andrew, and tell me your thoughts on this. Don't necessarily start with the tax thought process when you're getting started in real estate. Worry about scaling and then understand that what Andrew is saying, as you continue to grow that portfolio and you have more assets, income coming in, now you can offset those taxes. But dude, I'll talk to people who, they got a $50,000 net worth and they're making whatever, 100 grand a year. And they're messaging me wanting to know what they can do to save in taxes. And I'm like, well, you could have that conversation, but here's my advice to you. Just go buy a bunch of property and scale your income as much as possible. Let's start there. And then once you have that problem, then start looking, all right, how do I mitigate these taxes? Would you agree?
Yeah, I mean, this goes back to the point of being loanable. Like, you need to be intentional about being loanable. If you write off everything and you show $10,000 of income, good luck getting approved for a house hack, right?
Yep.
So in the initial phase, and I did this for 10 years, is I paid my taxes. I showed a strong income on my tax return. That's what lenders use to determine your lendability, right? So I think it's incredibly important if you are trying to be loanable, which that's the best debt out there, and I would highly recommend people do that in the beginning, is pay your taxes initially, and as you build up, multiple side hustles, spend out multiple forms of cash, that's when you should think about sheltering it.
Yeah. Great advice. I love it. I love it. So you're big in the multifamily space, and I want to dive into that. I'm a huge single family residential guy. I love it. Now I own through partnerships. I own call it a skyscraper, like for the South. We don't have big skyscrapers, but in our city, Greenville, I own a piece of skyscrapers. I own commercial buildings. I own parts of all that, but I am an LP in all of those. I
Mm,
don't drive the ship on that. I just give money and say, go buy it, guys.
yeah.
But I love residential because it's just so easy. I mean,
Mhm.
it's pretty standard across the board. All the multifamily guys I talk to, it's like we got to know what we're going to purchase it for. What's the rehab going to be? What are the rents going to be? And then what's the ARV going to be when we go to sell it? That is all it is for residential. And that's the bones of multifamily. But you guys start factoring in cap rates and NOIs and you start looking at other different metrics. So I don't sit here and act like a multifamily expert. I know enough to be dangerous. But
Mhm.
you have taken the initiative to say, bro, this is my sandbox. What steered you in that direction?
What steered me into multifamily was just, in my opinion, it's the safest asset class. Like, if it works as multifamily, it's going to work as everything else. It's going to work as a medium term rental. It's going to work as a short term rental. It will work for rent by the room. Like, it will work for every strategy. So it was just the safest real estate class, in my opinion. And that's why I stuck with it. And what I will say is, I don't get shiny object syndrome. Like, other people will like, try to do 20 different asset classes and be average at one at all of
Yep.
them. Like, I like to be a superstar at one asset class, and I went all in the multifamily, and that's what I know, and that's my bread and butter. And like, yeah, maybe there's better asset classes out there. Maybe you'll make more money in short-term rental, but this is what I decided to build my riches in, and it's worked for me. And I tell people this all the time, like, there's a million ways to become a millionaire. Just pick an
Yes.
asset class, go all in, become an expert, and you will make money.
I love this advice, man. People get so scatterbrained. I call it spaghetti brain. We coach a lot of folks. So people come into our world, and bro, when they start talking, it's just like I can see these noodles just spinning, and it's so just jacked up inside of their brain because they just can't make a decision on one. And I get it. I understand it though. Because if you're listening to podcasts, even this one right here, I'm saying I love residential. You're saying you love multifamily. And then you see a guy post about Airbnb. And then this guy's pushing storage units are the only thing you should buy. And then industrial building. Listen, loud and clear, folks. You can make a lot of money in any of them. I know deca millionaires who own just single family homes. I know deca millionaires who own multifamily, who own industrial parks, who own skyscrapers. There's money to be made in all of them. You got to make the decision on what do I want to go after and then put those blinders on. Done. Once the decision's made, done. Go into it. Does that mean you can't invest in other different asset classes? No. But if you heard me earlier, when I invest in other asset classes, there is an operator on the back end who's running that ship for me that I trust
Mhm.
and who have been able to build a strong resume in what they do. If I want to go buy multifamily, I'm not going to take the time today to go learn it and deviate from the business that's working for me with my burst strategy on single family homes. I'm going to call Andrew Freed up and I'm going to say, hey, bro, got capital. I'm ready to invest in a multifamily deal. What do you got going? And so then you can diversify that way. But I think that's down the road. I think start just like you said, Andrew. Choose what you want to do. Screw everything else that comes across your plate. Do not bite and go all in. And you've done it, and it has obviously worked for you. I've done it. It's obviously worked for me. So, what type of multifamily is your sweet spot? Where are you guys looking at? What have you seen that's working in this market? What do you try to attack?
I would say our sweet spot is between 3 to 50 units. Um, at the end of the day, I play in the residential space. 2 to 4 in my case because I'm multi, or 5 plus, and it doesn't really differ from asset class. Like, I mean, to residential to commercial. Like, yeah, maybe like you have to take cap rate into account during the refinance, but it comes down to is price per unit. How much is it going to cost to get to stabilization, and what's your rent? Like,
Yeah.
that's all it comes down to at the end of the day. And as long as you get a really good price per unit, there's a ton of upside on the rent. It's not going to be too strenuous to get there because I don't like to take. I like to focus on assets that are operationally inefficient but conditionally in good shape because I'm a good operator. So that allows me to be in and out of a project in 3 to 4 months and get it stabilized versus spending 6 to 12 months on a huge value add project, right? So that's been my bread and butter. I know others have different tactics, but I've been able to scale quickly by just moving into a project, getting it stabilized, and moving on to the next.
One thing that intrigues me about commercial properties is comping.
Mm-hmm.
So when I'm comping a residential home, dude, as you know, me and you both could get on Zillow right now, pick an area, and know what homes are worth and what they're going to rent for within what 3 minutes tops. Maybe a little
Mm-hmm.
bit longer if our internet's moving slow. You literally can hop on Zillow or PropStream or whatever app you use, Realtor.com, look at previously sold homes that are comparable, and you're going to know price per square foot what things are
Mm-hmm.
selling for. Same thing with rents. You can call a
Yep.
property manager, get what the rents are going to be, or you can hop on Rentometer or whatever app you use and see what average rents are going to be. And then within 3 to 5 minutes, all right, I know what this market's selling for. I feel
Mm-hmm.
as though there's a little more work in the commercial space strictly because you don't have usually, sometimes you do, depending on the density of the area, but you don't have those readily available comps, I guess, at scale, the volume of comps. So, what's that process look like for you guys? How do you know where you need to price it at? And then what those rents are going to be and where you need to get them to and where you think you can get them to?
Yeah, I mean, you bring up a lot of good points. It's a lot more challenging to find comps in the area, but that's why it's really important to know your market, right? Because if you play in the residential space, I mean, units for commercial are a little cheaper, but not that much cheaper than residential. So if you know what units sell for at the residential space, you have a pretty decent idea of what they sell for at the commercial level, right? And when it comes to cap rate, I mean, obviously talk with brokers like who know property in the area, but it's also like a spectrum. Like if you're going to Boston, like expect to pay a 3 to 4 cap rate. If you're moving out of the city, it's got to expand and expand and expand, right? So how far are you from a major metropolitan area? I mean, you might be able to get a good gauge just by seeing where you are geographically to a really high end metropolitan area, right? Like it's not, but like I said, my main metric is not cap rate, it's cash on cash return. Like what
Yeah.
is my yield? What is my return on that money?
Yeah.
Appreciation, forced appreciation, equity. I mean, that's bonus. That's icing on the cake. but the property has to be self-sustaining and provide a good cash flow in the interim, or I won't buy it regardless.
Love it. Out of state investing. It's a hold up for most people. We were just talking, you're buying whatever, halfway across the country down here. I guess not across the country, but down on the bottom end of the country from where you live. Um, I believe that it's a big hold up for most because a lot of people live in areas that just don't afford themselves to investing in, call it long term rentals, for example. Let's say somebody wants to get in a long term rental. If you live in New York City, if you live in Boston, if you live in Austin, Texas, Nashville, Tennessee, LA, I mean, go down the list where people like to live, it's very hard to make that work. And so they can either make two decisions. One, you can decide, I'm not going to invest, or two, you can say, no, I'm going to take the initiative and I'm going to go invest elsewhere. What's that journey been like for you? What would be your advice to people who've been letting that hold them back?
So a lot of my investing has been in my own backyard. I do like control. I do like to ensure the asset performs in accordance with the business plan. If somebody is doing out of state investing, I highly recommend that they invest in a place where they have somebody on the ground that they trust implicitly,
Yep.
right? So if you are going to decide to do out of state investing, you could go a couple different options. You can do syndications, right? You completely LP and you're vetting the syndicator, right? Or you can find you can make a list of all the people you trust implicitly and where do they live, right? And that might direct you to maybe a top 3 market. And at that point, like that's the market I would probably choose, because I mean, at the end of the day, it's like everybody in real estate is incentivized to make money off of you, right? So you need somebody there that you can trust to provide oversight on the agent, on the property manager, right? On your team. And that's what I recommend if somebody's considering out of state, is like find some boots on the ground that you trust. And that's exactly what I did when I invested in Lancaster, South Carolina. I'm probably butchering that
Have to
last
have
name,
that.
but yes.
Lancaster,
Yeah,
Lancaster, baby.
Lancaster, sorry,
You say
Lancaster.
Lancaster,
Lancaster.
they're gonna take that building from you. I walked in there one time. I was in sales, and I was like, "Yeah, this is the first time I've been to Lancaster." They're like, "Sir, it's Lancaster. Don't forget." I was like, "All right, I got you." I did that another time in Albany, Georgia. You think you would pronounce it Albany? Like,
Yeah.
that's how you Albany, New York. Albany, Albany, and
All
bro,
Benny.
they
All Benny.
they're offended if you say it wrong. So I'm just trying to save you. If you make the trip down there, Lancaster, bro, you will thank me later. You will
Thank you.
thank me later.
I
But
appreciate it.
Andrew, where can people find you, man? This has been fantastic. I've loved hanging out with you.
Likewise, thanks for having me. They can find me on Instagram at Investor Freed. They can also find me on Facebook and LinkedIn at Andrew Freed. Always feel free to reach out. Always happy to connect with other investors.
Love it. Guys, and if you have not yet joined my free Burr Real Estate Facebook group, go down to the show notes of the show. You'll see a link for it. Check it out. I'm also going to link Andrew's links to his pages so you can connect with him. Shoot him a DM. Shoot me a DM. Let us know you watch this. We'd love to thank you personally for taking time out of your day. Andrew, I want to appreciate you and thank you again for being on. This was fantastic, and we'll talk soon.
Thanks.